vehicles, mutual funds and exchange-traded funds, or ETFs. Think of them as your trusty sidekicks on your investment journey. They offer a simple and effective way to diversify your portfolio, spreading your risk across multiple assets. Whether you're aiming for long-term growth or seeking regular income, there's a fund out there for you. But with so many options available, it can be overwhelming to know where to start. That's why we're here to break down the basics, helping you understand the ins and outs of mutual funds and ETFs. By the end of this guide, you'll be equipped to make informed decisions about which investment path is right for you. So, buckle up and get ready to embark on your journey towards financial freedom. It's time to demystify the world of investing and unlock your financial potential. Welcome to Section 2, Demystifying Mutual Funds, a basket of opportunities. Let's start with mutual funds. Imagine a basket filled with different stocks or bonds. That's essentially what a mutual fund is. When you invest in a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of assets. This diversification is key. It helps reduce your risk because even if one investment performs poorly, the others can cushion the blow. Mutual funds are professionally managed, meaning an expert selects and oversees the investments within the fund. This can be a huge advantage, especially for new investors who may not have the time or expertise to research individual stocks or bonds. There are countless mutual funds available, each with its own investment objective, risk profile, and fee structure. Some funds focus on specific sectors like technology or healthcare, while others track broad market indices like the S&P 500. The beauty of mutual funds is their flexibility. You can find one that aligns with your financial goals, whether it's saving for retirement, buying a house, or funding your child's education. When you invest in a mutual fund, you're purchasing shares of the fund itself. The value of your shares fluctuates daily based on the performance of the underlying assets in the fund. This makes mutual funds a liquid investment, meaning you can easily buy and sell shares at the end of each trading day. Welcome to Section 3, Exploring ETFs, the allure of index investing. Now let's shift our attention to exchange-traded funds, or ETFs. Like mutual funds, ETFs also offer instant diversification by investing in a basket of assets. However, they operate a bit differently. ETFs are traded on stock exchanges, just like individual stocks. This means their prices fluctuate throughout the trading day, giving you more flexibility to buy or sell at any time. Most ETFs track a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. This makes them a popular choice for investors seeking to passively track the performance of a particular market segment. One of the key advantages of ETFs is their low cost. Because they are passively managed, meaning they typically track an index rather than relying on a fund manager to pick individual securities, ETFs tend to have lower expense ratios than actively managed mutual funds. Another benefit of ETFs is their tax efficiency. They are structured in a way that minimizes taxable distributions, which can help you keep more of your investment gains. ETFs offer a wide range of investment options, from broad market indices to sector-specific funds and even bond ETFs. This allows you to tailor your portfolio to your specific risk tolerance and investment goals. Section 4. Spotting the differences, mutual funds versus ETFs. Now that we've covered the basics of both mutual funds and ETFs, let's delve into some key differences to help you decide which one might be a better fit for your investment style. One key distinction lies in how they are priced. Mutual funds are priced once per day, at the end of the trading day, based on their net asset value, or NAV. ETFs, on the other hand, are priced in real time throughout the trading day, just like individual stocks. Another difference is their trading flexibility. You can only buy or sell mutual fund shares at the end of the trading day, based on the NAV. With ETFs, you have the flexibility to trade throughout the day, taking advantage of intraday price movements. Fee structures also differ. Mutual funds typically have higher expense ratios compared to ETFs. This is because they are actively managed and involve more overhead costs. ETFs, especially those that are passively managed, tend to have lower expense ratios, making them a more cost-effective option for many investors. Lastly, there's a difference in trading costs. When you buy or sell mutual fund shares, you may incur transaction fees, also known as loads. ETFs, on the other hand, are bought and sold like stocks, so you'll typically pay a brokerage commission each time you trade. Section 5, Pros and Cons. Making the right choice for you. Both
जी, तो
mutual
हाजिर
funds
हो गया
and
हूँ
ETFs
आज एक
offer a
नए
world of
आर्टिकल के
investment
साथ।
opportunities,
माशाल्लाह बहुत
but each
प्यारा
comes
सी
with its
मैंने
own set
आर्टिकल
of
आया,
advantages
सेम कलर
and
की।
disadvantages. Let's weigh the pros and cons to help you determine which option aligns best with your financial goals and investment style. Mutual funds, pros, diversification. Mutual funds provide instant diversification by investing in a basket of assets, reducing your overall risk. Professional management. A fund manager handles all the investment decisions, freeing up your time and providing expert guidance. Convenience. Mutual funds are easy to buy and sell through brokerage accounts or directly from the fund company. Cons. Fees. Mutual funds typically have higher expense ratios compared to ETFs, which can eat into your returns over time. Less trading flexibility. You can only buy or sell mutual fund shares at the end of the trading day, based on the NAV. Tax implications. Mutual funds can generate taxable distributions, even if you don't sell your shares. ETFs, pros, low costs. ETFs generally have lower expense ratios than mutual funds, making them a more cost-effective option. Trading flexibility. ETFs trade on stock exchanges, allowing you to buy or sell throughout the trading day. Tax efficiency. ETFs are structured to minimize taxable distributions, helping you keep more of your investment gains. Cons. Trading costs. You'll typically pay a brokerage commission each time you buy or sell ETF shares. Expense ratio. Variations. While generally lower than mutual funds, expense ratios can vary among ETFs, so it's essential to compare. Liquidity. While most ETFs are highly liquid, some niche ETFs may have lower trading volumes, potentially making it harder to buy or sell at desirable prices. Section 6. The verdict. Which one should you choose? So, which one is right for you, mutual funds or ETFs? The answer, like with most things in personal finance, is it depends. The best choice for you hinges on your individual circumstances, financial goals, and investment style. If you're new to investing and prefer a hands-off approach, mutual funds can be a great option. They offer professional management and diversification, making it easy to get started. For cost-conscious investors seeking tax efficiency and trading flexibility, ETFs might be the way to go. Their lower expense ratios and intraday trading capabilities can be a significant advantage. Ultimately, the key is to do your research, understand the differences between mutual funds and ETFs, and choose the option that best aligns with your investment goals and risk tolerance. Remember, there's no one-size-fits-all answer. The best investment strategy is the one that you understand and feel comfortable with. As you embark on your investment journey, remember to start small, diversify your portfolio, and stay informed. Whether you choose mutual funds, ETFs, or a combination of both, the most important thing is to start investing early and consistently to build a secure financial future.